You know, for decades, traders have been locked in this really fierce debate. Is technical analysis a powerful tool that can actually predict the future? Or is it all just one massive self-fulfilling prophecy? Now, this isn't just some academic question, it really cuts to the core of how our financial markets actually work.
So let's think about it like this. Are we dealing with a market crystal ball, or is it more of a market mind game? Do the charts we look at reveal what's gonna happen, or do they just show us what everyone else is thinking, which then kind of forces all of us to act in a way that creates the future that was supposedly predicted? Yeah, that's the puzzle we're going to try to solve today.
But before we can really answer that, we got to make sure we're on the same page with the terms. So let's quickly define the two key players in this whole debate: technical analysis and, of course, the self-fulfilling prophecy.
Okay, first technical analysis. Basically, this is the art of looking at past market data, price charts, trading volume, all that stuff, and using that history to try and predict what's going to happen next. These analysts have a huge toolkit they believe can give them clues about what's just around the corner. And on the other side of the coin, we have the self-fulfilling prophecy. This happens when a belief, whether it's true or not, causes enough people to act in a specific way that they actually make that belief come true. It's an idea that pretty much wills itself into existence.
All right, so now that we've got that straight, let's dive into the first side of this argument, the case for technical analysis being a genuinely predictive tool. I mean, what makes so many traders swear by it?
Well, the people who are really into it will tell you that time and time again, this stuff just seems to work. You look at tools like support and resistance levels, or trend lines, or those big moving averages. So often, prices will move and then just stop or reverse right at these key lines, almost like it was planned.
Now, for these believers, this isn't some kind of voodoo. They argue that the reason these charts work is because they're tapping into the market's fundamental mechanics, that constant tug of war between supply and demand, the collective psychology of all the traders out there. In their eyes, the chart reveals the market's actual DNA.
But now, for the twist. Let's flip this whole thing around and make the case for prophecy. What if the magic isn't in the charts at all, but in the millions of eyeballs that are all staring at them?
So here's the core argument from the skeptics. These indicators don't actually predict anything. The only reason they seem to work is because millions of traders are all looking at the exact same charts, they've all learned the exact same textbook rules, and they're all ready to act in the exact same way at the same time.
Let me give you a perfect example of how this plays out, the famous 200-day moving average. So many traders see it as this critical line in the sand, so they place their automated stop-loss orders just below it. So what happens? The price drops, it touches that line, and bam! It triggers this massive cascade of sell orders all at once, which forces the price down. Exactly like the signal predicted it would, the prophecy fulfills itself.
So this is the real conflict, right? You've got one side that believes the chart reveals the future by showing us these deep market forces, and then you have the other side that believes the chart creates the future through this coordinated crowd psychology. Reveal versus create. That's really the heart of the whole debate.
So which one is it? Is it a crystal ball or is it a mind game? Well, the reality, as it so often is a bit more complicated. It turns out both sides are kinda right, up to a point.
First, let's be really clear about this. That prophecy effect, it is absolutely real. When thousands and thousands of traders all act on the same signal, their collective power can and does push the market in the direction they expect. It's a powerful, real-world example of crowd psychology in action. But, and this is a really big but, while that effect can be powerful, its influence is almost always short-lived. A sudden lurch in price caused by a technical signal says very little about where that price is going to be weeks or months from now. So why does it fizzle out? Well, you have to remember, the market is a pretty chaotic place. You've got countless traders, all with different, conflicting goals. There are hundreds of different indicators, all flashing competing signals at the same time. And, looming over all of it, are the fundamental forces, things like company earnings and economic data, that eventually, always, pull prices back to reality. One signal and one group of traders following it just can't fight that tide forever. Okay, so after all of that, what's the real takeaway here? When we cut through all the noise of this debate, it really all boils down to one essential insight.
And that lesson is all about understanding the dynamic that's really at play.
It's this. Price moves that get triggered by technical signals aren't magic. They are usually just these short-lived, self-reinforcing feedback loops. The engine driving them isn't some secret market code, it's the very visible, very predictable patterns of human crowd psychology.
So I want to leave you with one final question to think about. If a technical signal works mainly because everybody believes it works, is it actually a smart signal, or is it just a popular one? In the wild world of the market, figuring out that difference might just be the most important skill of all.